When U.S. regulators approved the first spot Bitcoin ETFs in early 2024, it was hailed as a watershed moment for digital assets. 1 year later, the story is more complex than the headline suggested. Institutions have entered, but cautiously, balancing access with ongoing concerns about volatility, liquidity, and regulation. The launch brought a flood of interest. In the first quarter alone, U.S. spot Bitcoin ETFs drew more than $10 billion. BlackRock's iShares Bitcoin Trust led the way, attracting nearly half of all inflows. At one point, it was even pulling in more net daily inflows than SPDR gold shares, hinting at a shift in the store of value debate. The early adopters were largely pensions, endowments, and insurers allocating 0.25% to 0.5% as test cases. Hedge funds and family offices followed, viewing ETFs as a regulated, transparent bridge into crypto markets without the operational risks of custody. But after the surge came a slowdown. By mid-2024, weekly inflows had flattened or turned negative. Rising bond yields and persistent inflation concerns led institutions to rebalance towards safer assets. Smaller ETFs struggled, with some unable to hold more than $100 million in AUM. Redemption spikes often coincided with market pullbacks. In March, when Bitcoin corrected from $73,000 to $59,000, ETFs saw $1.4 billion in weekly outflows. Yet many of those flows returned in subsequent months, proof that institutions weren't abandoning ETFs, but managing them actively. Perhaps the biggest shift has been how institutions integrate Bitcoin ETFs. Rather than speculation, they're being slotted into alternative and hedge sleeves alongside commodities or real estate. Typical allocations range from 1% to 3% in balanced strategy. Larger endowments are using rebalancing triggers, selling into rallies, and topping up on dips. Consultants note this mirrors gold ETF adoption 2 decades earlier, where institutions gradually built conviction over time. As of mid-2025, U.S. spot Bitcoin ETFs hold around $65 billion. That's dwarfed by the $500 billion in gold ETFs and trillions in equity funds, but impressive for a 1-year-old product. For context, gold ETFs took nearly 5 years to surpass $50 billion after their 2004 debut. By that measure, Bitcoin's adoption curve has been faster than expected. 1 year in, several lessons stand out. First, ETF wrappers reduce friction, simplifying access and custody. Second, liquidity risk remains a concern. While ETFs trade intraday, execution quality depends on exchange depth. Third, volatility is part of the package. Allocators must build frameworks that tolerate sharp drawdowns. Finally, ETFs provide comfort, but conviction will only grow as Bitcoin performs across different macro environments. Here, consultants are playing a critical role, guiding institutions through phased adoption and governance. The next frontier is already in motion. Ethereum ETFs are under SEC review. Institutions are also pushing for diversified crypto index funds and tokenized treasuries. Tokenized real estate and credit funds are attracting early interest, signaling a blended future where ETFs and blockchain-based investment products coexist. 1 year on, Bitcoin ETFs can be judged a success: steady inflows, manageable outflows, and growing integration into portfolios. At Kenson Investments, we help institutions navigate this evolving landscape with confidence, clarity, and strategy for the long term.